Yeah, now we'll use the dividend discounted model to do the valuation. So we'll try to see based on the dividends that we have forecasted, what should be the value of this particular firm, or what should be the price of the share of HUL as per our understanding, right? So that is where we are trying to go and find out the value of equity. So we'll create one sheet called valuations. I'll create one sheet called valuation, right? So here the first model I'm going to look at is the dividend discounting model. For this, what I need is I actually require the dividends. What are the dividends that are typically forecasted? So 1 year from now, I'll take probably something as year. 1 year from now, 2 years from now, probably we have forecasted the dividends up to 5 years from now. These are what are the dividends which we have forecasted. So let's take those forecasted dividends. Let's take those forecasted dividend where I typically talk about from the income statement. Dividend is coming from the income statement. So 1 year down the lane, this is what is the dividend I am thinking of. So this should be the dividend 1 year from now. Now 2 years from now, 3 years from now, 5 years from now, these are what are the dividends, right? Now my next point that would be of very much use for me is the company is not just existing for 5 years, it is existing forever. So every year it will give some kind of a dividend in the future also, right? So the typical way that is expected is, now think of something that it will be growing forever, right? But what we can see is, see, any company for that matter, it has a life cycle. It cannot exist, I mean, for an infinite period. We have seen so many companies which have closed down in the last few years. So many big companies also have either merged with something else or gone off out of the business and all, or probably towards their later phases they cannot grow at this rate. Now we are seeing that the sales is growing at 15%, 12% kind of stuff, but probably after a certain point the growth may not be that much. So there is always a point which says the long term growth rate of a company in terms of sales, if I, because my focus is infinite period, now it is at 15%, but this 15% growth cannot be there forever. If you are seeing the recent growth percentages, 15.24% is the rate at which industry has grown, and even the sales growth has been phenomenal. What is the sales growth here? Sales growth is also almost 13.05%, right? The company's sales is growing at 13.05%. It cannot grow like that forever, right? So see, today it must be beating the GDP on a very comfortable margin. But a day will come where some other company, see, GDP at the end is sum total of all the company's sale. So if this company has generated 13% growth, but GDP has grown only by 7%, it means some other companies would have gone lesser than that 7%. That's where the average wise the GDP has grown at 7% itself. So what typically is the assumption as a part of the valuation process people do is, look at the current growth rate, let's say 13%. Assume something as your long term growth rate. So let's say long term growth rate cannot be more than 4 to 5%, because in some periods it is much. See, even for a developed country, the GDP will not grow at more than 3-4%. So at some point or the other, we have to expect that the country has to go more and more developed, or even if it is developing, now the rate may be higher, the growth rate may be higher, but after a certain point, the growth rate may be much, much lesser. So the typical assumption always is the long-term growth rate, you assume at around 4% or 5%. Let's say we'll again model it as 5%. Now what has to be the process now is, suddenly from 13 it cannot go to 5. So what I can do is, over another 5 years, I'll gradually get it down to 5% with no other assumptions changing. I'll gradually get it down to 5%. For that, what is required from my side? I just need to assume that the sales will grow at 5 probably from 13 it may go to 11, it may go at 9, it may go at 7, slowly it will come to 5 over a period of 5 years. And after that, I will assume that it will grow at 5% only forever. So even if it is some plus or minus during a period, it would be adjusted in some other numbers, because immediately after 5 years it may not drop to 11. So something plus or minus over a long period will be adjusted in the process. So what I am doing as a part of the next step is the growth for the next 5 years. I am forecasting one number. So what I am doing, I'll take it as growth is sales growth. I'll take as sales growth for 6 to 10 years, because for the first 5 we have already got. So from 6 to 10 years, my intention is to slowly bring it down to that 5% mark over a period of 5 years. So probably here also I'll take this no, the long term growth rate is almost for any company. Because see, the simple way is GDP is nothing but the sum total of goods and services, right? In a long term, once the company goes more and more developed, which may happen, so the GDP of that country will not grow at more than 3-4% for a developed country, which means all the companies, see, if I typically look at some solid companies in US today, their annual growth rates in sales are not more than 4-5%, because the scope of growth will not be there beyond a certain point. It's already saturated, it's already matured kind of stuff. So and even if it is not also, the companies typically will not exist forever. So there is always a chance that after 20 years this company no more exists. But we are looking at modeling it, assuming that it will exist for an infinite period. So the growth rate, we generally won't, long-term growth rate, we generally don't assume at more than 4% or 5%, which is taken for, and if I am doing a US company, probably I'll reduce that number even more. I'll reduce it to 3% or something. Because India is currently in the developing phase, the growth rates will be much higher for the first few years. So overall average would be around 5 or something like that. Whereas when I am doing it for US, every year it will not grow more than 4-5%. So even in the long term, at the max, I'll assume it as 3%. That's a typical way any growth rate is being taken. So probably for all Indian companies, you can very well go with this assumption of 5% or at the max 6%. Nothing more than that, because in the long term, the company cannot see. I mean, probably we have to think like this: HUL cannot exist forever, right? See, we have seen so many companies which have come closed down. They are not going for a beyond this, but we are talking about the valuation. If I invest something today, and not sell off that security, I'll get the dividends for my generations also. So I need to have some kind of a base at what rate it will grow forever. So the typical assumption which will go, see, otherwise the other way to look at is change that number, alter it to suit to the current stock price. We'll do that process also. Right now I am assuming it as 5%, but I can very well change it to adapt it to the current stock price. Right? Now, the another thing for me in this process is now I have to see that the growth will come down, from that 13% to 5% over a period of next 5 years. Right? So for that, what I am trying to do is I have to find out what is the latest growth. Right? From there I'll bring it down to 5%. Not on the dividend, on the sales. The latest the latest growth rate, I'll take it as whatever I have forecasted. The latest growth rate, whatever I have forecasted to the last, the growth rate in sales, I am taking it as this much. So the latest growth rate is almost 15%. Yeah, 15% is the latest growth rate in sales. Now what I want to do is over the next 5 years, or let's say if I am using the EIC analysis, just to quickly change it, instead of manual, if I go with the EIC analysis, again there also I'll get the same calculation. But here it will say that the long term latest growth rate is only 13.05%, because the EIC has shown a growth rate of only that much. Now I'll try to find out what is the growth, so that over a period of 5 years it slowly comes down to 0%. 5%. Over a 10-year period, from 6 to 10, that 13.5% growth will come to 5% growth. And from 10th year onwards, which is 2022 or something, from there per eternal, I'll assume that it will grow at 4% or 5%. Right? So that growth rate, now I am taking it as this number. Gradually I have to decrease it over a 5-year period. So what I will do is this number minus whatever is the difference I am having, the difference between these two numbers, I'll reduce it by 0.2. 20% I am decreasing, because if it has to decrease to 5 over a period of 5 years, every year there should be a decrease of 20%. So I am taking this numbers. So it is saying next year it has to be 11.44%. Now the same logic, if I extend till the last, this one I'll do it as 40% the next year. So which will makes it 9.83%. Then it goes as 60% decrease. 8.22%. Then 80% decrease, making it 6.61%. And 100% decrease is making it 5%. So by the time it touches the 5%, 10 years from now. So if I simply do it here, let's say I assume that long-term growth rate is only 4%. Automatically my calculations are also updated to touch that 4% mark. So that's what is the advantage I'll get by again creating it as a model. So now the next 5 years sales growth is going to be this much. Now I can very well forecast the financial statements for the next 5 years, assuming that they will grow at 5%, rest all ratios being the same, right? Now if that's the case, again come back to your income statements. Instead of 2017 now, I'll take it up to 2022. The only difference now I will make is this one. I'll increment directly with this percentage, which I have got from the valuation sheet. I'll increment it by 11.44%, because the next year sales is going to grow at this much itself. Now the rest of the things I can just drag, because I'm assuming that they are going to be the same from then onwards. So what I'll simply do is, all the earlier formulas, I'll simply drag them. I can do that, right? I can simply drag all the formulas, because it's only the sales that is changing, nothing else. Now probably I can even do it at a time itself. So you select all of them, right? You select all of them and simply drag them. You will get that these are the numbers for the next few years. This is the financial statement for the next 5 years, assuming that the growth will gradually come down to 5%. The sales will grow at 5% by 2022, right? Now the same way I should be able to forecast the balance sheet, where I'll do a similar exercise. The same thing I'll drag 2022 up to. Now again this entire values I can simply drag, because the assumption is going to be the same across. So this is what is going to be my balance sheet figure for the next few years. Now this is what is coming out as, there is the mismatch that is coming up, right? Because these are not coming out as zeros. The difference between your assets and liabilities, that is coming out as zero, because the cash flow statement we haven't forecasted it. The next 5 years we did not take the cash flow statement, and that's where the cash position is showing the same number throughout. So what I should do for the cash flow statement also, I should project it for the next 5 years. So the moment I take this, if my balance sheet should be balanced now. If it is not, then there is something wrong with my analysis. All right. So let's see now. The balance sheet got balanced. Now from here, I'll take what will be the dividend for the next 5 years. See what we have done here. For the first 5 years from now, we have simply assumed whatever is the growth rate from the GDP or whatever analysis, through EIC analysis or through manual or whatever it is. So for the first 5 years, immediate 5 years, we have assumed it through that way. After that, for another 5 years, we are assuming that it will slowly come down to a long-term growth rate. The growth will not be at, right, the growth will not be typically at 11% or 15%, but it will come down to 5%. And after that, forever, it will be at 5% itself. Right? So 5 or 4 or whatever we have taken as the percentage, forever it will be at that percentage itself. Now, in this 5-year period, I know what are the dividends. So, I'll take those dividends for this next 5 years. These are the dividends for the next 5 years from 2018 to 2022. So, which I will take again as slowly, gradually decreasing. So, the dividend is coming out for me here as this is the dividend in 2018. Probably this is up to 2022. This is what is the dividend that is going to be there. Now from there, I am assuming that the growth will be 5%, right? Forever. So if the growth is 5%, I want to find out what is the growth in the dividend. By what rate is the dividend growing? If the growth is 5%, what is the rate at which the dividend is growing? So for that, all I can do is, I can very well find out. I'll try to increase this sales for one more year just at 5%, just to see what is the dividend in that particular period. So what I'll do, this sales, I'll simply increment it with the long-term growth rate. Whatever the long-term growth rate we are assuming, at this rate, I'll increase the dividend, the revenue. Rest all I can simply forecast. This is the number, and probably I can do the same on the balance sheet. Okay. This is what is my balance sheet, and probably this will be my cash flow statement. So once a model is there in place, that's where you can just simply drag off the stuff and everything will be addressed for you. Now why I am looking at this part is, for me, now when I come back, the balance sheet is still balanced, no problem. But here I want to see at what rate is the dividend growing forever, right? What is the growth in dividend now? From 5992, it has become 6291, right? From 5992, it has become 6291. So from here, I can find out what is the growth in the dividend forever, because from there, every time it is 5% increase only. So the dividend also will grow only by this percent every year. So I can very well find out. We'll try to change the long-term growth rate. Based on that, we should see that the dividend also will change. The 11th year dividend for me is simply this value. This is my 11th year dividend. So what I can see is eternal, this is what I call as eternal growth rate in dividend. This will come out to me as this number minus this number divided by this number, which in this case is 5% itself. So nothing much to worry about. Even the sales are growing by 5% and dividend is also up by exactly 5%. So this is what is the eternal growth rate in the dividend. Now from here, the way I will proceed further is, these are the dividends for the next 10 years, 1 to 10 years, and from 11th year to infinite, it grows at 5% forever. I can very well make it as an assumption that it grows at 5% forever. So that 11 to infinite period where the growth is 5%, I'll find what is called as a terminal value. See, if I have a constant growth rate from a particular period, it could be from year 1 onwards or it could be from year 10 onwards. From wherever I am having a constant growth rate in any particular value, this goes with a mathematical concept called geometric progression. Wherever there is a constant growth rate, right, the sum of all the present values of the future values to the present is simply given by, so this is what I call as terminal value, which is nothing but value from year 11 to infinite as of year 10. So from next year onwards, there is going to be an infinite rate. I mean, for an infinite period, there is going to be a constant growth. So when I am at 10th year, I am seeing from 11th year onwards, there is going to be a constant growth rate of 5% forever. Right? Probably if I make this long-term growth rate as 4%, probably the eternal growth in dividend is also becoming 4% itself. All right. So let me make it at 5%. So what I can very well do is the terminal value is nothing but value from year 11 to year infinite as of year 10. That is given by a simple direct formula as per geometric progression. The year 11 value divided by cost of equity minus eternal growth rate. This goes purely with the geometric progression formula. So probably if there is a model, we can directly use the formula in the model, probably without getting into the theoretical aspects of that. Because see, it's nothing but it's an infinite series. Sum of an infinite series of a geometric progression is actually goes with the formula called a by 1 minus r. That's the sum of infinite terms of geometric, where a is the first term and r typically is the ratio of the values. By what extent the second one is bigger than the first one. So going with that, that's the same logic which we are applying here. So here it is nothing but year 11 value, which is this one, divided by cost of equity. Oh, we have to get the cost of equity. I can pull it from the other sheet, but let me bring it directly here. Cost of equity, I am getting it from this sheet. This is my cost of equity. So here I'll directly put year 11 value divided by cost of equity minus the eternal growth rate. So this is coming out to 1,12,863 crores. This is the value as of year 10, not as of now, because we are talking of constant growth rate from year 11 onwards. So this value, the formula whatever is coming out, is as of year 1 period before. As of year 10, this is the value of that security. Now I want to know what is the present value of that terminal value. The present value, I can use a formula called PV, because by 10 years I have to bring it down. Right? I have to discount it as of today, not as of 10 years later. So that is where I am calling it as present value, where the first thing I need is the rate. The rate is nothing but my cost of equity, 10.57%. Then the number of periods is actually 10 years, because this is the value at the end of 10th year. So this is the value at the end of 10 years, 1 lakh, whatever is the number, that's the value at the end of 10 years. So the PMT is, if it is a uniform value across for all the periods, I'll use PMT. But this is a lump sum value, 1 lakh 12,000. So I'll use this as FE. FE is the future value. Future value of this company after 10 years, or of this share of this equity after 10 years, is going to be 1,12,863 crores. So as of now, if I want to bring it, it is worth around 41,000. The same 1 lakh, I'll just make it into positive. The same 1,12,000, which is the value after 10 years, discounting it at 10.57 interest rate per year, it boils down to only, which means 41,304. If I actually deposit it for 10-year period at 10.57% interest rate, the value which it will become after 10 years is 1,12,863 itself. So that is what we are calling as the present value today. So now we are talking about, so when I say a value, here my point is from year 1, which is the next year, till infinite, all the dividends that are coming, I have to find the present value and then say that this is the value of the equity share according to me, right? But this number of 41,304 is purely based on year 11 to year infinite, not from year 1 to year 10. So from year 1 to year 10, these are the dividends. These are the dividends from year 1 to year 10. So what I can very well do is, I should find out the present value of each of these dividends, right? Because this is the dividend after 1 year. This is the dividend after 2 years. What is the today's value of that? This is the dividend after 3 years. What is the today's value of that? So that's where I am calling the PV of dividends. For each one, I will find out a PV formula where the rate still I'll take it as 10.57%. But here the number of periods is only 1 year. This for this 22,212, it's only 1 year. So I'll take it as 1 year, and the FE here is only 2,200. Because this is the value of 2,200, I'll get as a dividend after 1 year, not now. Right? So based on this, this says the present value of that is around 2,000, crores only for the first year's dividend. Similarly, I will find for all the 10 years dividends. So these are the values for all the 10 years. So this one is 1,916, this is 2,000, another 2,000, 2,100. These are the numbers for the next few years. These are the numbers. So I can very well find sum of present values from year 1 to year 10. Year 11 to infinite is 41,300. Year 1 to year 10 is the summation of all these numbers. So which is giving another, let's say, 21,000. So the total value of equity is coming out to, this is from 1 to 10 and this is from 11 to infinite. So the total value is coming out to 62,819 crores. Now I can find out the price per share. This is the total value. Divided by the number of shares, I'll get the value per share. So the value per share will come out as this number, divided by number of shares. Number of shares. Is there any other way? Number of shares is not here. Okay, we'll take it from the shareholder funds. Oh no, I think we should be having it here. This is the, yeah. So we have the total number of shares. These many crores of shares are there. So when I divide it by this much number, I'm getting the value as 290 rupees. According to me, the value of HUL going with this kind of current assumption, with my assumptions, is only 290 rupees a share. Right? But currently, if it is much more in the market, I will typically say that over a period it will fall down. So it's better over, it's right now overvalued. So if required, better sell off that share. Because the kind of growth, whatever it is offering, you may feel that with the kind of growth that it is currently offering, the sales growth or whatever, it does not grow at, it does not deserve more than 290.63 rupees a share. Now, even if I go for the most optimistic, right, instead of EIC analysis, let's say I change to some other industry growth, something. Now I should see, even from that perspective, it is worth only 312 rupees a share. So it always is in a particular zone itself. Now 312 rupees per share is what is our dividend discounting model typically talking of. Right? So if it is right now, I think in the market it's around 500 odd. So which means it's already overvalued. You can very well expect that based on your assumption. See, some of your assumptions might be right, some of them may be wrong. So based on whatever are your assumption, you may very well say that the stock price for this company can either come down in the near future based on the current growth patterns of the company. We can expect that the stock price of it will come down in future. So the worth of it is just around 312 rupees a share, going with the dividend discounting model. So probably I may have to use couple of other models also, because it's always better to vet it with other models also, because each model looks at the value of the equity from a different dimension. So based on that, I should be able to make out what should be the worth of the share, going with different kinds of models. Going with a dividend discounting model, it is clearly saying that this particular stock is overvalued. For the simple reason, we are seeing that, or let's say if I change the beta just to play around, right, instead of taking this number as the beta, let's say I will take this, the latest beta, just to see what is going to be impacted. Yeah, just one second. So this is the beta if I'm taking, then the value is saying 1034. So beta, finding out a better beta is always an approach. So probably sometimes people may prefer, okay, look at not just 5 10 years or 1 year, probably look at it on a slightly intermediate kind of a basis, because if I'm going with a very recent beta, it is showing that the value of the company is going to be almost 1034 rupees a share. So that is giving me a decision of undervalue. But if I'm going with the beta of this much, which is pretty much giving, because minus 0.17 is a pretty recent kind of scenario, but may not be forever. So if I'm talking of forever, because all our forecasts are on a very long term basis. So from that point, probably may not be this, but probably somewhere in the middle also will strike a better number. So those kind of adjustments can still be done to make sure that our number is matching closer and closer with the actual. So where the number is matching with the actual, we can fix up those as the numbers, and based on that we can do the valuation for the next quarter or next year. So this is the model typically using the dividends of the company, right? We can use similar kind of models, the free cash flows or some other models also. This is a model going with the usage of the dividends of the company. We have forecasted first the dividends for the initial 5 years based on the assumption on how the stock is going, how the sales are going to grow based on the GDP. After that, we made an assumption that for the next few years, over the next few years, the sales will drop down to a long-term average of 5%. And after that, we are saying from that forever, the sales are going to grow only at 5% per year. If that's the case, we are seeing that if that's the case, we are seeing that the growth rate in the dividends is also around 5%. So based on that, we have used the formula terminal value from year 11 to year infinite, found out the present value of the terminal value, then year 1 to year 10, whatever were our dividends, we have discounted them to the present value, added all the values, and finally said that this is the total value of the equity of the security. And I'll compare that value with the market value. If it is higher than the market value, I'll say it is overvalued. Lesser than the market value, I mean, if my security is greater than, I mean, if my valuation is greater than the market price, I'll say that it is undervalued. I'll go for a buy recommendation on this security. If it is the reverse, I'll say it is overvalued, and I go for a sell recommendation on the security. That's the typical way we use this kind of a process to value the equity of a security. The same logic we'll have to use now for valuing using the free cash flow to the equity rather than using the dividend. So dividend is, I mean, free cash flow is used as what I call as is proxy in place of dividend, because dividend may not be, I mean, dividend is governed by the management. So there may not be a chance of the dividend, whatever the dividend the company is giving is stable. So in that case, it's always better to go for a better approach, which is used as a proxy to dividend. And people have designed with a value called free cash flow to the equity, which is actually designed as a proxy to the dividend. Right?
Theoretical sense, what does terminal value mean? Terminal value.
See, terminal value is nothing but, see, we are talking about the value. See, if I have to talk about what is your value, right? Simple assumption is based on how much potential you have to earn from next year till whatever years you are alive. I'll try to find out. I'll try to remove the interest rates factor from all of them, and I'll try to find out what is your value. That is what typically a companies can do while valuing an individual. Right? Now, if that's the case, what we are doing here is I require from year 1 to year infinite. But I have forecasted using some cash flow statements and all. I have forecasted from year 1 to year 5 and even from 5 to 6 to 10. But how long? I can't do the forecasting up to infinite. Right? So I'm trying to aggregate year 11 to year infinite. I'm trying to aggregate that entire benefit. See, when I say I'm investing something today, the investment is purely based on the benefit, perceived benefit. Benefit in case of equity investment is only dividend, right? Unless I sell the stock where there could be a capital appreciation. But here we are talking of not selling the stock. Forever, for infinite, I'll keep getting the dividend. At what rate I will get the dividends? I am using an appropriate model to forecast. I have forecasted it first for 5 years. What are the dividends? Then another 5 years, assuming that the sales will grow down. After that, I am assuming at an infinite rate, I mean for an infinite period, there would be a growth of around 5% in the dividend. So that I have to add up all those numbers. from year 11 to year infinite, what are all the dividends? That addition of those dividends is what is the terminal value, which has come out to. So if I take all those dividends from year 11 to year infinite, it is working out to almost 1,23,970. Year 11 to year infinite, all the dividends worth, but that is the value as of 10th year. Because the formula which we have used is from the next period onwards, wherever there is a constant growth. That formula is applicable only for scenario of constant growth. And the constant growth is happening only from 11th year. So this value is of 10th year. Now I have to find out as of 0th year, which is today. So I have to find the present value of all that, which has worked out to 45,369. Similarly, the dividends that are declared from year 1 to year 10, this is what are this? Again, I have found out the present value of all of them, because each dividend is at a different time period. I am bringing all of them to the today. So what I am saying is the today's benefit of all the future benefits. If I remove the interest factor of all the future benefits that I am going to get, it is equivalent to 67,501 crores. So the value of the company, I don't need after 1 year or after 2 years. I want to know as of now, because my investment is as of now. This is the value of the equity share as of now. So I'll divide it by the total number of shares, which will provide me what is the value per share, because this is the total market value as per my expectation, not as per the market. As per my projections, the value of the equity of this company is going to be 67,501. This divided by the total number of shares, which will give me what should be the price per share of this company, which works out to 312.29. So then I'll compare it with the market price to decide whether it is overvalued or undervalued. Right?